I decided that I would come up with a list of 5 things that you can do to start to assess your professionals in your life, whether that's your accounting professionals, your investing professionals, your insurance professionals, your exit coach professionals, your business coaches. How can you assess them to make sure that it's not all about the bang, but you're actually getting substance behind it? Because at Big Life Financial, we want the substance. We actually want the change. We want the highest value. We want you to actually achieve what you're looking for, not just get the big bang lack of substance. So here are those 5. Number 1, the advisor should be able to show you the outcome with numbers and be able to prove it to you of how it could happen. They shouldn't be afraid to show you numbers. If they're afraid to show you the how, there's probably something wrong. It doesn't mean you have to know the numbers inside and out yourself. It just means that they should be able to show you if you ask them to prove it to you. So for example, if someone says, we're going to get an 8% return to age 70, and at age 70, we're going to pull out this X amount of dollars until you die. You should ask them, is that a gross number or a net number? Is that before fees or after fees? Is that before taxes or after taxes? And what's the percentage chance that that number right there that you're giving me is going to sustain me till my death? Is it a 90% chance? Is it a 100% chance? Is it a 20% chance? Like, they should be able to show you all of that and prove it to you. And you should be able to catch on to it, because though math can be complicated, if they know it, they can simply explain it. They wouldn't run from the numbers. They're not going to say things like, it's too complicated, you wouldn't understand. They should openly share the numbers with you. So number 1 is they should openly be willing to share the numbers and prove it with the numbers to you. And that goes for business coaches. We're going to scale our business by 10, 15, 20%. It should be able to be backtracked all the way back to you. Like it can be defensible to you, and they should be able to show you. The second thing is that they should be very open about their fees. So I want to dive a little bit deeper into the fee thing so that you can start assessing what fees should I be expecting to see and how should I be asking them. So number 1, if you're buying an insurance product, we'll start with an IUL. The IUL fee structure is on the illustration. And if it's not, you can request it from the companies. You should know those fees. And the reason you should know those fees is as we were just looking at our client's IUL policy, his illustration. He's in his retirement age, and his policy was going to eat itself with just the fees without him pulling any money out with just the fees alone. Don't you think you should know that before you buy it? So you need to make sure you know the fees of IULs, because it's blatantly stated, and the fees will rise every single year you own the policy, just by the nature of what an IUL is. It's an annual renewable term, and that's how the fee structure works. But you should be able to see the fees and see how big it gets and understand them. If it makes sense, then purchase the product. But if it doesn't, know beforehand. Now, with whole life insurance, the fees are locked in. They're not going to rise over time. When you buy a whole life policy, you're guaranteeing that cost for the rest of your life. So you don't have to worry about them raising the fees on you or raising your premium. It's locked in, and you can know the fees in year number 1. You can look at the illustration, you know what they are. That's why whole life policies always go backwards in the beginning, because there's fees associated with them. You have to pay for the death benefit. You have to pay for the customer service team. You have to pay for the agents. You have to pay for the lawyers. Like, you have to pay for all of that stuff. And so you need to make sure that you're buying a product that you know the fees about. So just know that those exist. And if it makes sense, buy the product. Just one note on whole life insurance. It needs to be purchased from a dividend-paying mutual company. There's only about 12 in the country. So there's hundreds of life insurance companies, but only 12 of them are the company that you should buy whole life insurance. On the accounting side, just know what value is being brought. Like, how do you know, like, are you actually saving me taxes, or do I just pay an exorbitant fee just because? Because I'm a dentist, because I'm a business owner who makes a lot of money, you just charge me more because? Have them prove it to you, and what are the fees and what value comes from those fees. On the investing side, know what is your asset under management. What are the commissions you get? Do you get commissions? Are there load fees by putting things in the mutual funds? Are there back-end fees when I pull things out? Are there fees on my 401ks and my IRAs and my cash balance plans? What are the fees that are associated with me putting money into your custody or your control. They should be able to say those very plainly. You should know the fees. Blindly paying fees will cost you probably millions of dollars over your lifetime. You're too successful of a person and too high of an income earner to not just blindly pay fees. It compounds over time. The third thing to help you assess your advisor is, are they exclusive or anti something? So again, we're going to look at the insurance industry. So in the insurance industry, there's a lot of people that only sell insurance. Now, there are some people that only sell insurance that do an extraordinary job and they don't fall into this camp. So I'm not painting a broad brush here, but there are far too many insurance agents that only sell insurance, and they only sell insurance. And because they only sell insurance, they are combative and fight everything around them. So they're going to fight things like, well, our product can outperform the market, or our product can do better than that. Our product can do that. So they're pointing fingers at everyone else, trying to take down their products and their solutions to get them to buy their product. So that's probably a red flag that something is wrong. Now, doesn't mean you shouldn't buy insurance. It just means that you don't want to work with that type of advisor. There are plenty of insurance advisors that don't behave that way, that they might only be insurance advisors. So you got to find the ones that aren't so combative and show you the value of their product without tearing down everything else. In the accounting space, you're going to see it where accountants will get really defensive, where they become a one-man or one-woman team, and it's just me. I'm the expert of all things tax. So when you bring strategies up, no, that's going to cause an audit, or this is too risky, we can't do that. And they're not open to expanding their network of teams, because you're a successful business owner that's making top 5%, top 1% income in America. Your needs are different than the vast majority of middle-class Americans. So to the middle-class American, that might be the wrong answer, but to you, there are things that you should be thinking about tax-wise. And if they're unwilling to expand their team to bring that in, it probably is a sign they aren't the advisor for you. On the investment side, it's the same thing that the insurance agents do. They become super defensive around anything that challenges their circle of what they sell. So if they're offering you investments in the stock market, for example, or mutual funds, and then you say, let's go get this insurance product because I think the insurance is going to provide some protection for me. It'll give me a death benefit. It'll allow me to have a greater distribution retirement. They're going to immediately say no, because they're going to say insurance is terrible. When the reality is at your level of play, the math says it's likely, the math in my experience, every analysis that I'd ever ran, says that whole life insurance will enhance your portfolio. It won't ruin your portfolio. So if they're getting that answer, it probably means that they're obsessed with their things and they want you to buy more of that. So they're going to say things like buy term and invest the difference. They're inviting you to put more money into their control, into their assets under management, or into their ecosystem so they can make more money off you. Again, it doesn't mean they're bad people. That's just who they are. But they're the exact same person as the insurance salesman, but they just happen to sell investments instead. You need someone that is more open to being holistic and bringing in more people and more strategies, because at your level of income, the more strategies don't always mean it's better, but they oftentimes can enhance your portfolio. The fourth thing to bring into your situation and to help you audit your team is to ask them how many people are on your team. And make sure you're really specific. You're not talking about their office, because in their office, they probably have underwriters. They probably have some lawyers that do compliance. They probably have a chief investment officer. They probably have a due diligence team. We're not talking about that. Is what I'm talking about when I say team. I'm talking about other professionals that don't do what they do, that are a part of their network. And it's not just a referral, like we're in a collaborative relationship with this person. At your level of income as a successful business owner, making mid to high six figures into the 7-figure range, you need a tax and financial team, not just tax and financial people. So their team should be expansive. It should have accountants on it. It should have investment advisors on it. It should have insurance people in it. It should have exit planners in it. And they should all be collaborating. It shouldn't just be you send and refer. We're all working together. They might not be a part of the same firms, but at least they're available. Teams produce, individuals for high income earners don't. The fifth thing to help you audit your team and to make sure that your advisor is right for you is asking them, and this is more of a self-reflection, but are they more focused on needs instead of wants? Needs are looking at the bare minimum of scraping by, of how much do we have to do to get to this level. It's like a scrap meat. You're not looking for abundance. You're trying to hit this bare minimum of living expenses and lifestyle. Versus wants is, how big do you want your company to go? You want it to be 20 million, 50 million, 100 million? Like, have members of your team that push you to that level. How much of an impact do you want to make? Do you want to get your name on buildings? Do you want to have a scholarship named after you? Do you want to help poverty-ridden countries get wet water? Do you want to get your name on a school building? Do you want to leave an imprint? How big do you want to go? And how much wealth do you need to make that impact? The want advisor, ironically, covers the needs, but also pushes you into a new paradigm, a new way of thinking, a new vision of who you can become. You want an advisor, you want an advisory team that makes you think that way. Too many people in the financial industry are obsessed with needs. We should be looking at wants. How much help can we do? How many problems can we solve? So today, we looked at the 5 areas that you can assess as a business owner on if your advisory, your accounting advising, your investing advising, your insurance advising, your exit planning advising, your business coaching advising, if they're providing a quick flash substance like the fruit stripe gum, or do they have substance behind it? Do they have things that actually happen and play out for you to make a change? Number 1 was they're very open with you around the numbers. They're willing to prove it to you. You don't have to have it proved to you every time, but when you ask questions, they can show you, here's the numbers behind it. Here's how it worked. Here's how we backtracked from that $100 million exit valuation. Here's the steps we have to take all the way down to here. Like, provable to you. Number 2 is they're very open about their fees and you know the fees. Number 3, they're not exclusive to any one strategy or idea. They're open to other things and making a more holistic planning approach versus singularity focus. Number 4, it's a team of people, not a single advisor. It's not just the accountant. It's not just the investment advisor. It's not just the insurance agent. Everyone's in collaboration. You need to create the family office for yourself, and that's why it needs to be done. 5th, your advisor is focused on wants instead of needs. I'm Justin Maxwell from Big Life Financial, and I hope this was a valuable exercise that helps you assess whether your advisor is a middle-class advisor or a world-class generational advisor. Which one do you choose?